Well, good morning or afternoon, everyone, depending on where you're listening from. Thanks for joining us today. My name is Doug Hanson, and along with Ryan Diamisi and Nick Daniels, we'd like to welcome you to this Christian Wealth Management webinar. It's a challenging time for everyone. Here in Idaho, we are on a 21-day stay-at-home rule, but we are making the best of it and praying for resolution. These challenging times have played out in many ways, including the stock market. Today, we have the opportunity to hear from Jason Myhre, co-founder and managing partner of Eventide Asset Management. Eventide has been a leader in the values-based investing movement, and we are excited to hear more about investing that makes the world rejoice, especially in light of recent stock market movements. Jason, thanks for joining us today.
It's my absolute pleasure. Thanks for having me. Well, hello, everyone. I'm calling you today from Louisville, Kentucky, where I live. My company is on a stay-at-home policy, and happy to join you in my afternoon here. So, sorry again. Okay, so I want to talk to you today about the timeless truths for investing success. And just to set the stage, by the way, I guess I'll back up and give you a little bit of my background. So as Doug said, I'm managing partner and co-founder of Eventide. We are a values-based investing, faith-based investing mutual fund company headquartered in Boston. We manage about $3.2 billion in assets. My day-to-day work is in an area we call advocacy, where I advocate for the application of your values to investment decision-making. You'll hear a little bit about that in my presentation today towards the end. Okay, so just to set the stage, as we speak, this is not going to be any surprise to you. The United States is the epicenter of coronavirus worldwide, with an exponential ramp in the growth of new cases. Very scary time that we live in. We're all cloistered away in our homes. And this has brought the economy largely to a grinding halt and has roiled the investment markets, where in 1 month, pretty amazing, we have experienced the fastest market decline in history. And then last week, the fastest gain since the 1930s. And so with this roller coaster ride that we're on, and with fears abounding, question is, how do we think about investing? What do we do about our investments during this time? Is there anything to do? How do we sort of situate ourselves again and remember what is classic and timeless? And so that's what I want to talk about. I want to crystallize about 150 years of investing success as we've accumulated it at Eventide Asset Management into 5 points, which I'll walk through in order. They are: keep your eye on the owner, not the dog; restrain yourself; employ a system that forces you to buy low; trust in the most powerful force in the universe; and invest in businesses, not stocks. All right, we'll start with this first one. Keep your eye on the owner, not the dog. What do I mean by this cryptic phrase? This is perhaps my favorite quote on investing. Comes from this person shown here, Ralph Wenger, who was a legendary investor of the Acorn Fund, which had a remarkable track record. And Ralph Wenger once explained how markets work. This is recalled by Bill Bernstein in one of his books on investing. The quote reads, "He likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. The dog's owner is walking from Columbus Circle through Central Park to the Metropolitan Museum. At any one moment, there is no predicting which way the pooch will lurch, but in the long run, you know he's heading northeast at an average speed of 3 miles per hour. What is astonishing is that almost all the market players, big and small, seem to have their eye on the dog, not the owner." I want to show you this. This chart actually took some work to construct here. This is looking at the entire history of the US stock market, going back to 1871. So some of you may know that the S&P 500 began here in 1926, but we have books of all the data on the stock market preceding this time period. And so we can actually reconstruct the methodology of the S&P 500 using these historic stock price returns. And then we're performing 2 transformations on this data. One, we're adjusting it for inflation as it changed over time. and reinvesting the dividends in the market. And when you perform these transformations, you get this amazingly predictable experience in the market. I mean, look at this. So the blue line represents all of the ups and downs in the market, typified in the analogy by the dog on the long leash. And the yellow line, which is, this is a linear line, it's flat, there's no curvature to this at all, goes in a straight line up and to the right, headed northeast as though the owner were walking from through Central Park to the Metropolitan Museum. And you can see that that's been a constant rate of growth. In fact, this constant rate of growth has been called the, quote, Siegel's constant, named after Jeremy Siegel from the Wharton School of Business. And that constant growth rate is 6.6%. And so we ought not to be too concerned with the direction the dog is lurching this way or that. As a matter of fact, you can see this is almost up to the present day in March. I got as close as I could before having to submit this to compliance. But you can see that our present situation is just a blip on the map on this long-term trajectory. And so we have to keep our eyes focused on this long-term trend rather than on the day-to-day vagaries and the ups and downs of the market. So this will frame much of the following discussion, which is really, many of them are techniques about how to adhere to, how to best adhere to this long-term growth trend. Okay, point number 2, restrain yourself. What do I mean here? To introduce this point, I want to go back in time a little bit. This is from the Wall Street Journal. You can see the date here is December 31, 2009. Every decade, there is a new mutual fund that is crowned king for the preceding decade based on total return. And at the end of the 2000s, from January 1, 2000 until December 31st, 2009, that winner was the CGM Focus Fund. It says, meet the decade's best performing US diversified stock mutual fund, Ken Hebner's $3.7 billion CGM Focus Fund, which rose very impressively 18% annually, meaning 18% per year over that decade, and outpaced its closest rival by more than 3 percentage points. Just an interesting personal anecdote here. The building that our company is headquartered in Boston, same building that Ken Hebner works in. So I've ridden the elevator with him at least on one time that I noticed. And so this is really an impressive return. Some of you may remember the 2000s. It was called the, quote, lost decade, the worst decade for investing in history. The market experienced 2 bear markets during that period. And so his 18% is really impressive. Now, an interesting thing is what the article goes on to say next. How did the average investor do by investing in this mutual fund? Check this out. Too bad investors weren't around to enjoy much of those gains. The typical CGM focused shareholders lost 11% annually per year in the 10 years ending November 30, according to investment research firm Morningstar Inc. So the fund was up 18% a year. Meanwhile, the investors in that fund got a negative 11% per year return. And so they underperformed the fund that they were invested in by 29% per year. This is the best possible investment they could have made over that time period. And they lost money every single year. Now, how in the world is this possible? The article goes on to explain. These investor returns, also known as dollar-weighted returns, incorporate the effect of cash flowing in and out of the fund as, and here's the key point, shareholders buy and sell. Investor returns can be lower than mutual fund returns because shareholders often buy a fund after it has had a strong run and they sell as it hits the bottom. So this is classic investor misbehavior. They basically see this fund, oh wow, this fund has an attractive track record, let me buy it. So they buy it when it's expensive at the top. Then the fund experiences a downturn and people say, wow, this fund is a dog, I'm gonna sell it, get me out of here. And so they redeem their investment, they sell it at the bottom, and then the fund is hot again, so they buy it at the peak, and and they ride it down and they sell it out at the bottom. This happens over and over and over again. My own company is a mutual fund company. This same investor behavior happens inside of our fund day in and day out. There is a famous maxim by Warren Buffett. Many of you will know his name. I would say this is probably one of the top 3 quotes of all time that people know in investing. He says, "Be fearful when others are greedy, and greedy when others are fearful." In other words, you know, when people are panicking, that's the time that you want to be buying, because you're buying at a lower price. And when people are being greedy and being euphoric, the market is probably hitting a peak, and you want to be fearful at those times because a downturn is likely around the corner. Now, everybody loves to quote this adage by Warren Buffett, but there is a world of difference between saying the right thing and doing the right thing. In fact, it's very easy for us to sit back and to mock the shareholders of the CGM Focus Fund and to not recognize that those same behaviors are resonant within us. So just one point on this. This is a book on psychology written by Nobel laureate in economics Daniel Kahneman. It's called Thinking Fast and Slow. Perhaps you've heard of it. It's gotten passed around quite a bit, at least in my world. And the very first page of the book says this: the premise of this book is that it's easier to recognize other people's mistakes than your own. It's easy for us to stand back and say, oh, I would follow Warren Buffett's be greedy when others are fearful, and then to sort of laugh at the investors and other funds who are making all the wrong decisions. So I want to generalize this concept and look in the mirror a little bit. We are our own worst enemy. So what we're looking at here are 20-year annualized returns on various asset classes. This is looking at 1996 through 2015. 20-year returns. These are annualized, meaning per year. So the best investment over this particular time period would have been real estate investment trusts. They returned 10.9% per year. You can see the S&P 500 returned 8.2% per year. This is a 60-40 blend of stocks and bonds. Then you can see a 40-60 blend of stocks and bonds, bonds themselves, gold. This is an international stocks benchmark. Homes, so the value of our homes increasing over that time period. Oil, you can see inflation, and then look at this. The average investor underperformed every possible investment that they could have made over that 20-year period. Isn't that abysmal? Just terrible. They failed to even keep up with the rate of inflation. Now, why is that? It is the exact same behavior that we remarked upon when looking at the CGM Focus Fund. People love to buy things when they're expensive, ride them to the bottom, and sell out. They love to try to dance in and out of the market, to try to time it to their best advantage, and end up reaping the whirlwind. This is terrible, and we have to restrain ourselves from this behavior because it can ruin any investment strategy, no matter how well designed it might be. I love this quote by Morgan Housel, who says, finance would be better if it were taught by psychology and history departments at universities. Couldn't agree more. We looked at the history on the dog and the owner and just remarked upon the psychology there. Another famous investor, Jesse Livermore, from way back in time, he says, the big money is not in the buying and the selling, but in the sitting. We have to stop this behavior where we're trying to time the market and to outsmart the market. We make all the classic mistakes and it costs us dearly. Okay, employ a system that forces you to buy low. We all know the best time to invest is when prices are low. And maybe now you're thinking about investing further as the market is perhaps reaching its bottom here. And so I want to talk about a system that we can employ that will force us to buy low. And to introduce this, I want to offer you an experiment here. You have a choice to make. So I want you to suppose that you are dropped into history anywhere between the year 1920 and the year 1979, and you have to invest in the US stock market for the subsequent or following 40 years. So you could be dropped into history, let's say 1929. You could be dropped in history 1941. 1967, you get the idea, and you have to invest for the following 40 years. You have a choice of strategies. You have two to choose from. Number one, you can invest $100 a month. Number two, you can save up that $100 a month, keeping cash on the sidelines, and then try to buy into market dips as the market crashes at various times, and to try to time those dips in the market to where you can buy at the absolute bottoms between any two relative highs. But I'm going to sweeten the deal. Option two, I'm going to also grant you perfect knowledge of the future, so that you are always guaranteed to buy the dips at precisely the right times, at precisely the absolute bottoms between two highs. Which would you choose? I suspect that some of you, based on how I framed this question, will feel that option one is so preposterous that you might just play the contrarian and say, oh, I'd take option one. But I assure you that people think, on the whole, that option two is a far superior strategy. Well, someone actually performed this experiment. They looked at every possible year and subsequent 40-year period. So if you landed in 1952 and you had the next 40 years, they tried both strategies and proved out which one would be better. And it's not a slam dunk. So what I'm going to show you here is the buy the dip strategy. That was option number two, where you have perfect knowledge of the future. If it's above the dotted line, that means you would have outperformed with that strategy. And if it's below the line, you would have underperformed with that strategy. In other words, option one would have been better to choose. And so you can see that if you were dropped into the 1920s, you could have timed the Great Depression and you would have done really well. That would have been the superior strategy. And you can see again, there's a period of time at the end of the 1930s where you would have done better with the buy the dip strategy. But look at how much time is favored for option one, investing $100 a month. In fact, it's 70% of the time, regular monthly investment outperforms this buy the dip strategy. So 70% of the time, this boring $100 a month outperforms this buy the dip strategy. In fact, if I take away your perfect knowledge of the future so that you don't know when these market dips are going to happen, which of course none of us do in reality, and you mistime those dips, purchasing those dips by just 2 months, then the monthly investment strategy outperforms 97% of the time. Now, how can this be? Why is this super boring strategy outperforming something that should clearly work better? This is dollar cost averaging, and I want to explain this magic to you. So very simple. All dollar cost averaging is the practice of investing a fixed amount of money at regular intervals in time. So perfect example, $100 a month. Just do that like clockwork. The reason that this works is that it is a natural mechanism for buying low. So I'll show you this on a chart to follow, but just here's the words. By investing a fixed amount of money at regular intervals, this strategy will naturally buy more shares of an investment when prices are low. Fixed amount of money, when prices are low, you'll get more shares. And it will naturally purchase less shares when prices are high. If prices are high, your fixed amount of money is not going as far. I want to look at this using the lost decade of investing, same decade of Ken Huebner's CGM Focus Fund that I showed you earlier. This is what it looks like. It was an absolute mess. 2 disastrous downturns, including the financial crisis, such that if you just marked the decade here, you can see that you would have returned minus 24.1%. Some people say this is the worst decade in investing history because you would have lost 24% after investing for 10 years. Pretty painful stuff. Well, how does dollar cost averaging work in this type of market environment? So in the blue line here, you can see the number of shares that a fixed amount of money purchases. So when the markets are expensive, such as here at the beginning of the decade, your money goes farther, or excuse me, your money does not go as far. You end up purchasing fewer shares. As the market declines and gets cheaper, you naturally are able to purchase more shares for the same amount of money. Here the market is getting expensive again. Your dollars are not going as far. Market crashes. You end up accumulating a lot of shares. And just this boring kind of mechanism of dollar cost averaging, you see what it's doing here. You are in effect buying the dips. This is a very similar strategy where you're accumulating more shares when markets are bottoming. And more than that, you're staying invested, which I'll talk about here in just a moment. But if you just dollar cost average for the last decade, instead of losing 24%, you would have gained 5.9%. So not great, but a lot better than negative 24%. It was no longer a lost decade when accounting for dollar cost averaging, which is the normal method that most people should use to invest. And you can see here that the dollar cost averaging purchases nearly twice as many shares when prices are low. So you can see down here 3.5 shares up to 6.5 shares. And so that spread is almost 2x. So a very smart strategy. But there's another thing going on here which makes it far superior to buy the dips. And that I'm going to illustrate that using a Gallup poll. Okay, so I find this so fascinating. So there is a cognitive bias that pretty much everybody has, where we fail to recognize when markets are doing well, and we tend to think that markets are doing poorly. And this survey has been repeated many times by many different pollsters. I chose this one from Gallup. This was conducted, you can see, between June 27 and July 9, 2014. And what they're asking the people that they're surveying is, what do you think happened last year in the stock market? So this is in the history books, right? Everyone has access to that information. But do most people know how the market did? Most people do not. So the question asked, as far as you know, how did US stocks perform on average in 2013, the prior year? Did they increase in value, stay about the same, or decrease in value? If they increased, which of the following do you think comes closest to the overall increase in the US stock market in 2013? It was up 10%, 20%, 30%, 40%, or 50%. The market was up 30% in 2013. And you can see the stratification of the answers here. Less than 10%, to be precise, 7% of people accurately knew what happened the prior year in the stock market. We have this acute awareness to when markets are crashing, but market gains go unnoticed. In fact, many of you probably, if I were to survey you, couldn't recall what happened last year in the S&P 500. So the market was up 30-some%. And we tend to think things are just not going that well. Most people think the markets are either flat or even negative most of the time. And this, as I said, the survey has been repeated over and over and over. And so we are oblivious to when things are going well. Now, I think part of this is because of media coverage. So you know that in the newspaper business, there's that famous quote, if it bleeds, it leads. Something has to be bad news for it to make the news, to make headlines. And so these market surges and these long-term bull market sections of the market often go unremarked. And so it's not just that dollar cost averaging buys the dips. It's that it forces you to be investing when the market is naturally rising. Here's a quote: while you wait for the next dip, the market is likely to keep rising and leave you behind. While you sit on the sidelines with cash and say, I'm going to deploy this whenever the market crashes, the market is regularly rising, as I showed you on the dog and the owner, and it's good to get involved. Here's a unusual quote for us here. This is Napoleon Bonaparte's definition of military genius, but I think it applies equally to investing. He says, the man who can do the average thing when all those around him are going crazy. Do the average and boring thing. Invest a fixed amount of money over regular time intervals. All right, trust in the most powerful force in the universe. Believe it or not, Albert Einstein once said this: the most powerful force in the universe is compound interest. Pretty amazing. What is compound interest? I want to just first illustrate its power using a very expensive cup of coffee. So the US average for a cup of coffee as of today is about $3. And if you were to, instead of spending that $3 on coffee, invest that amount of money each year, after 40 years, how much would you have? And we're going to assume the growth rate, the Siegel's constant that I showed you at the beginning of the presentation, 6.6% growth, $210,000. So very expensive cup of coffee. Now let's talk a little bit about the magic of compounding interest and what that is. Okay, so my favorite definition of compound interest, all the definitions are very like technical and wonky. I like Benjamin Franklin's definition. He says this: money makes money, and the money that makes money makes money. Okay, so I'm going to explain this to you, showing you a little bit of the math on the calculation here. And I think it'll be really easy for you to grab onto this. So it's helpful to see the math. All right, so that $3 in coffee that you save, if you add up $3 a day, you get $1,095 a year. Okay, so that's the amount you're investing. It's growing at a growth rate of 6.6%. So at the end of 1 year of investing, you would have $1,167.27. It gets interesting in year 2, because what happens in year 2 is that you invest another $1,095, and then that gets added to what you already have from the previous year, $1,167.27. So bringing you up to this total here, $2,162.27. Hopefully this is all pretty easy and straightforward. Now, this is the amount that is being invested again, and it grows by 6.6%, giving you $2,411.58. And this goes on and really begins to snowball over time. It looks unremarkable at the beginning, but as I'll show you on a chart, it really begins to rapidly grow. And the longer that we can leave it sit, the more the magic of compounding interest takes effect. So just to look at Ben Franklin's definition again. So it's your money making money, and then it's the money that made money making money. So the interest is compounded, so to speak. It is interest on interest. And eventually that interest begins to climb substantially. So here's that expensive cup of coffee. The amount invested at $3 a day over 40 years would be $43,800. But you can see, because of the magic of compounding interest, that has grown to $210,303.97. We could also look at a more realistic example. Instead of skipping out on 1 cup of coffee, if we do what I would recommend doing, which is to max out an IRA and grow it at the same growth rate, you can see $240,000 becomes about 1.1 million after 40 years. And you can see that with the way that this line is sloping, it will continue. The longer you have a growth timeline, the more and more that it will benefit you. In fact, Benjamin Franklin ended up giving 2 gifts of $5,000, one to Boston and one to Philadelphia, with a stipulation that they were not allowed to draw on it for 200 years. There were some ways that they could access it after 100 years, but if you let it go 200 years, as he sort of required, it grows to a substantial amount. And so that $5,000 from Benjamin Franklin has been many, many tens of millions of dollars for the cities of Boston and Philadelphia. So really amazing the longer you have, which is why people encourage investors to get an IRA going for their kids or these kinds of things, because time is on our side. Yes, it is, for you Rolling Stones fans out there. And another quote from Warren Buffett: the stock market is a device for transferring money from the impatient to the patient. So let time do its thing. Stay in the market. Don't try to time it. Invest a boring amount on regular time intervals and let the market do its thing. All right, last point, and actually I think the most significant. Everything I've said up to this point has been what I would call a technique for giving yourself the best probability for long-term investing success. I want to now talk about a deeper understanding of investing that hopefully is an encouragement to us on a heart level. So at my company, Eventide, this is really kind of our mantra, that many people have completely lost sight of what investing is about. Investing has long been divorced from its original and most basic purpose, which is supplying capital to businesses. Instead, most investors are trying to profit from the market itself, almost like this abstract entity, rather than investing in any of the productive and intrinsic value of the underlying companies that make up the market. And so people aren't really interested in investing in individual businesses. They're sort of interested in profiting from this market mechanism. And what ends up happening is when we remove this ownership perspective, what are we left with? Our relationship is reduced to one of only performance. And if that's the case, guess what's going to happen? As the markets go up, we're going to feel great. And as the markets go down, we're going to panic. And this is going to go up and down with the rises and falls in the market. And so we will lose our confidence and our peace. We'll constantly be worried over and over. And this is not the way it was intended to be. Investing was originally about supplying capital to great businesses and partnering with them over the long term. Here's a quote from William Cavanaugh from DePaul University, who describes what it's like to be an investor. He says, retirement accounts tend to go into mutual funds where not only do I not have any idea how the companies that I have stock in are being operated, I don't even know what companies I have stock in. And these mutual funds tend to be run by an elite of managers whose one preoccupation is with increasing the bottom line. Maybe you felt this way, where you've wondered, what on earth am I investing in? Where are these profits coming from? And do I feel good about the sources of these returns that I'm receiving? Many people have misgivings about this, and it's very natural to feel that way when you're removed from the situation. Many investment managers are focusing only on the profits. And in fact, some even consider it to be a weakness if they know what companies they're investing in. This is a famous investor, Cliff Asness. He's in the Boston area where we're based, AQR Capital Management. I heard him speak at a Morningstar conference, which is an investor conference a few years ago. He made this astonishing statement. He said, I pride myself on not knowing what's in our portfolios. So here's the person picking stocks on behalf of his investors. And he's saying, I consider it a point of pride to not even know the names of the companies that I'm choosing on behalf of my investors. And there's a kind of cool rationality to this. Like, I'm so driven by the numbers that I'm not going to let anything malign my judgment. And so I looked around the room when this statement was made just to see how it was registering on the faces of the audience. And I could see a whole lot of admiration in their faces. But when we compare it to the original purpose of investing, to partner with businesses and to grow with them over time, we can see how far we've fallen. This is not something to celebrate, but something to lament. Investing is actually company ownership, whether it feels like it or not. When we invest, we are supplying capital to a business. And in return, that's what gives us the rights to receive any profits and growth, be that dividends or stock appreciation or what have you. In addition, when we take ownership in a company, we're taking on a level of ethical responsibility for whatever it is that business is doing in the world. And I think this can be for good or bad, and that we need to engage our values in this decision-making process as well. Since investing is ownership, I would argue that the first questions we should ask about investing are not financial questions, but ownership questions. Since we're connected to a business, we're also connected to a management team. We should have questions about management teams. We should have questions about a company's customers, employees, suppliers, communities, the environment, and even society broadly. And the best way that you can gain peace of mind is by knowing that you're stepping into a situation that you believe in and trusting that business over the long term. I'll share a really great quote with you here at the end on that. Some of the questions that should frame a thought process around investing. These are questions we ask at Eventide on your behalf. For a management team, we ask ourselves, would we want to work under that leadership team? We take the posture of a customer and say, how likely would we be to recommend their product or service to a friend? With respect to employees, how would we want our son or daughter to work at this company? Would we feel proud of them for that? With respect to society, on a scale of 1 to 10, where 1 is a new flavor of chewing gum and 10 is a cure for cancer, how much value does this product bring to humanity? And by the way, this can be negative, such as in the case of companies who make products that harm others and destroy life. If we were to walk into a supply center, would we be proud of the quality and working conditions? What would our reaction be if this company opened an office in our neighborhood, opened a supply center, plant, or factory? And does this company's environmental policy and actions leave a better planet for our grandchildren? There is a smart financial side to investing, but I actually think this business-centric perspective gives you the clearest perspective about what you're heading into, and this can give you peace of mind for the long term. This is a very long quote, but would you read it along with me? I really think this is important, and I want you to get this with me. So this is a quote from our Chief Investment Officer, Vinny Corvella. By investing with Eventide, you will grow in your peace of mind. Peace of mind is the byproduct of trust, and trust is the byproduct of knowledge. Many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up. On the other hand, if a person knows the business the stock represents, trusts the management team, and so comes to believe in the company, these declines are not so troubling. That person is a confident investor because history has shown that great businesses not only endure downturns, but emerge stronger, making these declines attractive points to invest further. At Eventide, we help investors understand the merits of our portfolio companies so that they can better appreciate what they own and thus transcend a mere chart-based financial relationship. Eventide investors can have a greater confidence and less stress because they are not buying mere paper or a derivative, but a portfolio of quality businesses they know and trust. After all, life should not be spent staring at a computer screen, watching ticker gyrations, but instead free from needless stress. At Eventide, we strive to help give you that peace so that you can spend your time on what matters most. We need peace of mind in this current environment, and the best way that we can gain it is by knowing the situation that we're stepping into. In conclusion, we help you to know the companies you own. There's literature on our website where you can read about the kinds of companies in which we invest. If you're an investor with us, you'll know what you own. What are the timeless truths for investing success? Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Trust in the most powerful force in the universe, and invest in businesses, not stocks. And with that, I'm going to hand it back over to Doug. Thank you so much.
Okay, thank you, Jason. Really appreciate that, both the technical aspects of investing and the ethical aspects of investing. A lot of food for thought there. So yeah, as Jason said, if you have questions, Nick and Ryan and I are available to answer those. And this is our contact information there. Many of you have received emails from us about the webinar too, and have other contact information for us. But we'd love to talk to you about investing or maybe other financial matters that you may have. And we are passionate about investing according to your values. And you heard that come through in Jason's presentation with the ethical aspect, and something we're very interested in. So we'd love to chat with you. Well, just in the essence of time, I'd like to close in prayer and then we'll be finished. So Lord, we do thank you for this opportunity we have to be good stewards of what you've entrusted with. Lord, we know from the book of Psalms, Lord, that you own the earth and all that's in it, Lord, and you just entrusted to us during our time on the earth. Lord, help us to be wise with what you've given us, Lord. Help us to grow it, but also be invested in the companies that are doing good in the world, Lord. And Lord, just thank you for this opportunity we've had to reflect on this during this time, a very challenging time we're facing, Lord. But thank you for your watchfulness over us and your guidance. And we do thank you for your blessing in so many ways. We pray this in your name. Amen.
Amen.
Well, thanks everybody, and have a great day. And thanks again, Jason.
Thank you very much.